Welcome, everyone. My name is Helen Wayne, and I'm a Senior Manager of Sustainability and Accounting at A4S. Thank you for joining our webinar today on Access Finance TCFD. Please note that we're recording the webinar and it will be made available on the A4S YouTube channel afterwards. These A4S Academy monthly webinars are open to Academy and non-Academy participants, and all are welcome. This year's cohort started the A4S Academy this June, and they are in full swing of designing their implementation plans for the next 12 months, whilst last year's cohort will graduate soon in November 2021. In case you're interested in learning more about the Academy and how you or a colleague of yours can apply, please have a look at the follow-up resources email we'll send out after the webinar. As announced to you in the pre-work email, we're excited to have 4 panel speakers with us today from BlackRock, CapitaLand, GSK and NatWest Group, who I'll introduce shortly. And just to provide you with the agenda for today. So the agenda will cover a discussion with our 4 panelists to understand the business drivers behind their TCFD commitments and the practical actions that they have taken to respond to the recommendations. That will be followed with a Q&A from the audience. We'll then have a brief introduction to the A4S TCFD resources available to you, and we'll finish with a wrap up. You'll be able to ask questions freely in the chat function throughout the webinar, so please do ask as we go along and we'll address these as part of the Q&A. And just to cover the learning objectives of this webinar. So after completing today's course, you'll be able to recall the TCFD framework and recommendations, translate the learnings of others on TCFD to your work, and apply the A4S TCFD guidance to your work. As normal, we'll be asking you questions about the content covered throughout the webinar using Zoom polls, which you'll need to complete in order to get your CPD and CPE points. So without further ado, I'm pleased to introduce today's guest speakers. We have Emily Fletcher, Emerging Market Fund Manager at BlackRock, Peng Vice President of Sustainability at CapitaLand, Cassandra Greef, Chief of Staff to the CFO at GSK, and Supriya Sobti, Climate and Purpose Lead at NatWest Group. You'll also be hearing from the A4S team, Helen Slinger, Executive Director, and myself during this webinar. So before we start the panel discussion, we'd like to start with a poll question and find out about your current disclosures against TCFD. So if we run the first poll, to what extent does your organisation currently disclose in line with the TCFD recommendations? Not at all, primarily just our greenhouse gas emissions, against 2 or 3 of the pillars, against each of the 4 pillars, fully, or don't know. Well, it seems everybody has answered, and we have the majority with primarily just greenhouse gas emissions. So hopefully the webinar should be quite a useful input into kind of how to approach TCFD. We'll now move on to the next session, the Q&A with our panelists, and I'll hand over to Helen Slinger, who will provide a brief introduction.
Welcome everyone, and welcome especially to our panelists today. We've got Emily, Cassandra, Peng and Supriya, and how refreshing to have an all-female panel. Today we're going to be discussing TCFD, of course, and in particular the increased level of interest and maturity of TCFD. So it's good to have some preparers and also some users of TCFD reports with us on the panel today. Just a reminder to our audience, if you have questions for our panelists as we go, please do add them to the chat function and we will come to those. So coming to you first, Emily. So as a representative here from BlackRock, BlackRock is obviously one of the world's leading asset management firms and a provider of investment management, risk management and advisory services with assets under management of over $8 trillion US. Of course, BlackRock was a founding member of TCFD and Larry Fink's annual letters to CEOs have called for companies to disclose climate-related risks in line with the TCFD and to include their plans for operating in a well below 2 degrees scenario. So today, Emily, I understand that you've been working on the recent launch of a sustainable fund, which looks at a wide range of sustainability indices and requires companies to report against the framework of TCFD. So I guess my question to you is around the recent surge of interest in TCFD. and BlackRock having been involved from the start, have you seen a noticeable shift towards a willingness to report against TCFD and an enhancement in the maturity of disclosures that you're seeing?
Thank you very much. I mean, the answer to that is yes, completely, definitely. So yeah, but as you said, BlackRock is a founding member of TCFD. And I think the way we would put it is that we really see climate risk as investment risk. And that's why we're really asking companies and requiring companies to start reporting under TCFD. So it just allows us to determine how well a company has assessed its exposure to climate risk. And as a long-term investor, it's really important that we understand what are the long-term risks that the companies we invest in are exposed to. So as you said, obviously, we've seen a huge increase in TCFD. I think it's gone from 1,700 supporters at the end of 2020 to around 2,300 supporters now. So huge increase, I think, in willingness. And as an emerging markets manager, I can tell you that that's really just across the world that we're seeing that huge increased interest in reporting under TCFD. For us, it's really helpful because it just starts to give us the ability to be able to compare what different companies are doing. So yeah, huge willingness, and it's really important from our side to see those reports.
Thank you. And coming over to Cassandra now, from GSK. So GSK is obviously a global pharmaceutical company with a 34 billion turnover. And back in November last year, you committed to ambitious new environmental sustainability goals for both climate and also for nature, recognise that interdependency. I understand that your aim is to have net zero climate impact and net positive impact on nature by 2030, and that you made your first voluntary disclosure against TCFD in 2019 and have further expanded the disclosure in your more recent 2020 report. So in terms of your role, Cassandra, I understand that you have been developing an internal finance and sustainability network to drive various topics, one of which is TCFD, and doing that indeed as part of our A4S Academy. So my question to you is around that finance team's response to TCFD. Could you tell us a little around how the team's role has evolved during the transition to mandatory reporting of TCFD?
Yeah, so thank you, Helen. So actually, GSK first started looking at the TCFD framework back in 2018. And as Helen said, we voluntarily disclosed in our 2019 and 2020 annual report. That was very much, I call now our part A, I guess, journey towards TCFD reporting. And you can actually read, we worked with the A4S and have done a case study that you can all read about getting started with TCFD. What I'm sort of referring to now as our part two is really with regards to TCFD becoming mandatory reporting in the UK for premier listed companies. And that's effective from the 1st of January 2021. So when we heard that it was going to be more mandatory, we knew that there was important work that the finance team could do to really step up and play a more of a leading role in preparations. Because even though we'd already collaborated with the sustainability team and external reporting, we knew that there was further opportunities really to leverage finance's knowledge and also their expertise in providing decision useful information through the annual report. So as Helen said, we created a working group which has members across sustainability. And actually, we started sooner rather than later. So, in previous years, possibly the TCFD reporting really focus might have kicked off in October time. This year, we've really started earlier and started having team conversations in around April and really focusing on upskilling. And so that goes both ways. So upskilling the sustainability team on finance practices and upskilling the finance team on sustainability practices as well.
Great, thank you. So if we delve a little bit now more into the strategy pillar, we touched on the 4 pillars in the earlier poll. So if we touch on the strategy pillar and looking a bit more in depth on scenario analysis. So just for context, the strategy pillar, the TCFD recommendations looks at key risks and opportunities, the impacts of those risks and opportunities, and the resilience of the organisation in different climate scenarios. And the strategy section is one of the pillars of TCFD that organisations can often struggle with the most because of that piece on scenario analysis, but it's often the most useful for decision makers. And perhaps Emily might comment on that in due course. Of course, the latest TCFD status report that came out last year noted that an explanation of the impact on climate change on a company's business and strategy was the most useful for decision making. So we'll now explore with our panelists how they've approached the strategy section of the recommendations. And to do that, I'll come to you first, Peng. So obviously representing CapitaLand here today, welcome to the panel. CapitaLand being one of Asia's largest diversified real estate groups with a presence in more than 250 cities, over 20 countries. Headquartered in Singapore, where you're joining us from today. Your portfolio spans across diversified real estate classes, which include integrated developments, retail, office, lodging, residential, and new economy sectors such as business parks, industrial, logistics, and data centres. So last year, you unveiled your 2030 CapitaLand Sustainability Master Plan, outlining the ambitious sustainability agenda with aims to build, enable, and accelerate the journey towards sustainability. And that you've elevated your global carbon emissions reductions target approved by the Science Based Targets Initiative for a well below 2-degree scenario. So today, Peng, I'm hoping that you'll be able to share your insights with us into the overall TCFD process and some of the challenges that you have faced to date. So touching on that strategy piece, if I can ask you to share with us how CapitaLand's wider sustainability strategy integrates with TCFD and vice versa.
Thank you, Helen. Thank you for the background. I think as aptly highlighted in the introduction on CapitaLand, our challenges, we are in over 20 countries, 20 different jurisdictions with different constraints and challenges that we face. But before, so to give a background on how we integrated with TCFD is that we started on this journey before TCFD was launched and announced. So I think it's more about the reality is that there are going to be a lot of standards out there. There's going to be a lot of frameworks coming up. And as an organization, we need to understand and see the interconnectedness of every piece. So in this case, we're talking about carbon, the carbon emission and climate change. And we started on our journey before TCFD, and we already decided it needs to be a top-down and a bottom-up approach. Top-down as in you're going to make it a responsibility, you're going to embed it in the remuneration. It takes time. So we actually started embedding sustainability targets into the remuneration of the C-suite. And bottom up, because you really need to have a very clear stakeholder engagement within the various corporate functions, as well as the various business units, actually for a global company. Then we have to be very clear about how you're going to integrate with the various corporate teams. One key department for us is our group risk management group. So climate change risk is integrated into our enterprise risk management framework, and it must be, and it continues to be, and it works in conjunction with the various teams. So just to give you another example, we also embedded into our investment process. As a real estate company, simply we can invest, then we can develop, and then develop from scratch a building. We will operate the buildings and we will divest. So we look through the life cycle and we embed it at the investment stage, right? In the investment stage, we're very clear before we invest in any new investment. We're very clear what are the targets that we need to meet. What are the risks if we do not invest that amount? But what will be the opportunity if we were to invest in greening the asset? And we will quantify that item, whether it's energy, water, waste, and other factors. And we actually want to come up with a factor called return on sustainability. Often we talk about return on investment. We want to talk about return on sustainability, cost avoided, which is actually the risk avoided. So I think it's a journey that we have undergone. And I looked at the A4S document on limited reporting, moderate reporting, and full. I will confess we're not at the full stage yet. As you correctly said, scenario is our biggest challenge. Just when we think we got it, it changed. But regardless, we will work on different pieces. Therefore, we are very happy to finally complete our technical study and then engage with SBTI, Science-Based Target Initiative, and had our targets approved for well below 2 degrees. And that's for our global portfolio, assuming our global portfolio will continue to grow. So that's just a bit of insight. I hope that answers the question, Helen.
Yeah, great, thank you. And I think what you were referring to there was our maturity map on TCFD.
Yes.
I think, yeah, fantastic. And for the listeners today, that can be found on our website on our Knowledge Hub. So thank you, Peng. So coming next to Supriya from NatWest. So for those of you who aren't familiar with NatWest, it's the largest business and commercial bank in the UK with a leading retail business. The bank is the big supporter of the business sector, banking around 1 in 4 businesses across the UK and Ireland. The bank is committed to make their own operations climate positive by 2025, having already achieved the ambition to make them net zero by the end of 2020, and aims to at least halve the climate impact of their financing activities by 2030. They're founding members of the Net Zero Banking Alliance and a principal banking sponsor for COP26 this year. Today, we are speaking with Supriya, who is the climate and purpose lead within finance at NatWest. She'll share with us, hopefully, her work to date on TCFD from the perspective of the banking sector. So welcome, Supriya.
Thank you.
So at the moment, TCFD is relatively new in terms of a disclosure framework. It's only been with us a few years, but it obviously has very different challenges for different sectors. So a key area of focus within the strategy pillar, as I've mentioned, is scenario analysis. So being in the banking sector, how have you approached this and how were you impacted by your own customers' approach to TCFD?
So as you mentioned, NatWest is a major bank in the UK, and as part of being that kind of big player in the UK, we are subject to the Bank of England's climate biennial exploratory scenario, which is in short kind of known as CBES. Or the climate stress test. The Bank of England introduced that last year. And once that came in, what we did last year was develop a pilot for a small portion of our book to start looking at what the climate impacts are. So just as background, from a scenario analysis perspective, we're looking out to 2050. And looking at various scenarios. So looking at a scenario where there's a lot of policy action, everything's controlled. Then there is late policy action, i.e. there's no kind of policies or government support, etc. happening till kind of another 10 years. And then there is we just continue as is and companies find their own way. So there's different ways to look at it, and we're looking out to 30 years from now, right? So all of us know how much uncertainty there is kind of looking even to the next 5 years, let alone the next 30 years. So I guess that's the first challenge. However, what we did last year is for a small portion of our corporate book and some of our mortgage book, we did a small scenario analysis kind of pilot. It was a very big learning curve for us. All of you who are trying to do the metric section will know how much data quality issues there are with climate data. I guess as a bank, our biggest challenge is that we know all our data, but we have a huge dependency on our customer data. So we are assessing our loan book, which is effectively loans we have given to other customers. So we need a lot of data from them on their emissions, on their production methods, on their strategies to mitigate climate risk. And all of this isn't something we as a bank have traditionally collected. So that was one of the biggest challenge. And we as an organization learned that we have to deal with those imperfections. It was a learning curve for the team that was working on it, but then we had to take the business through that journey as well. So the business teams are the ones that are facing off to customers, making decisions to lend. How do they incorporate the outcomes of the scenario analysis into their decisions? We haven't solved it. We are still going through that journey. This year, we have matured further our scenario analysis capability. Obviously, the CBES is almost due for submission, but as I said, we are not just doing it as a regulatory exercise. We are trying to use that from a learning perspective across the business to say, okay, what did we learn from it? How do we incorporate in our decision making? How do we deal with the data issues we have? How do we collect better data? And how do we kind of look out to that 30-year view without getting scared, but then kind of strategize in terms of what decisions we can make to mitigate the risks that come in at those future dates. So it's been really informative. It's been a great learning kind of outcome, and we are still learning, right? Climate is a massive journey we all are on. So it's still in progress, but as I say, while it's a challenge, it's also a great teacher, is kind of what we've learned.
Great, thank you. A challenge, but a great teacher. So some very useful information coming out of that analysis, I assume. Thank you. Coming back briefly to you, Peng, just to look a little bit more in depth at scenario analysis and the work that you've been doing there. Could you share perhaps a little bit about the financial analysis that you do and how it informs decisions around your real estate portfolio?
I think for real estate, it's very clear that one of the easier things to look at, and it's really not easy again, is physical risk, right? Our assets are physical. And I heard, Supriya, your comment, and, we work very closely with banks, so I can imagine, we are their scope 3. That's what one of our local banks was telling me. We are their scope 3 because we are on the lending book. Real estate company is a high capital intensive in the development sector. So for us, I think as long as you have geolocations, you're going to be able to map your assets. But the challenge is there are a lot of tools out there, and we have tried assessing the tools. And at a panel this morning, it was a very interesting comment. This company hired 2 consultants to work on its carbon measurement. And these 2 big consultants came back with different numbers because the assumptions were never the same. So I think the reality is that there has to be a call, there has to be some assumptions made. And the best people to make that call is for us as the asset owner. We own assets, for instance, in China. There are flooding zones in China. But when you just map it without knowledge, you would think, oh, it's a high flood risk. But we know our pet project in China is called Raffles City, Chongqing. We have done our work, and that river can go up to 191 meters on a 100-year record. 191 meters is about a 50 to 60-story building, just to give you a scale. When we built that building, we built it about 6-7 years ago. We put out upfront the CAPEX and OPEX, CAPEX actually. We built it to 195 meters above flooding level. So I think when last year the flood happened, we were the only asset that was still operational. So I think that is the conversation we need to have. We have done a flood analysis internally. We have mapped our portfolio. The reality is on different platforms, it comes back differently. I think the challenge for us is really to try and make sense of a lot of this data to embed it into our business, because flooding or no flooding, if that's where the business is, it's how we're going to mitigate it and still derive value creation out of it. So I think that's an example to demonstrate how we build it into our investment process, how we put in the budget up front, and how we can show value when some parts of the city were flooded, but we were fully operational. And therefore, we were the only place people could go if they're going to buy groceries, right? Then the reality is, how do we quantify it, for public disclosure? So I thought a case study would help in this scenario. But the transition risk is one of our biggest challenge, because transition risk, just regulation alone, every day because of the upcoming COP, right? The regulations are being announced and we just can't seem to keep track of it, but we also need to be realistic, because in certain developing countries, the taxonomy, let's say for the use of natural gas in transition, is going to be different. So I think that's a journey we're still working on. I hope that kind of clarifies or helps answer the question, Helen.
Yeah, and a really useful, tangible example as well to how that investment can pay off. Just as a reminder to our audience, keep those questions coming in, and I will get through as many of them as we can for the panel today. Coming back to you, Emily, just thinking about the scenario analysis and how it is still evolving in terms of how companies are responding, I can only assume that you have a number of data gaps as an investor as you look across all the different investee companies and the disclosures that they're making. I guess it would be good to just understand from your perspective, what are the key challenges that you have in looking across that data and making comparisons between the different organizations, and how can companies best respond to that?
Yeah, thanks. So I think there's a couple of things that we really look for. It's important to say I do work across emerging markets, so certainly there's a lot of data gaps, and we're very much at the level of just trying to sort of encourage and almost enforce where we can that basic level of TCFD. And it's really exciting that there's so much talk about scenarios, because it would be great if we can bring all of emerging markets up to the level where that's what everyone's talking about. But for us, I think there's a couple of things that we think are really key to be looking out for. The first one of those obviously is the clear management oversight and the accountability on that. That we know who it is we should be going to, talking to, and will be held up as being accountable, if it's not in place. And then I think it's that we're looking at this is something that runs through the whole business, that there's a recognition at all different levels that it is that what we're talking about in the framework, the climate risks are recognised and acknowledged everywhere, that this isn't something that's being done on the side, but it is fully integrated in the way the whole business is run. In terms of the scenario analysis, what we're really looking for, and the numbers, the actual sort of metrics and the targets that are put out there. What's really difficult for us is the comparisons. Everyone reports different targets, different years, different metrics, different ways of doing it, and the targets are so set. We're looking to try and make those comparisons. We're looking to try and judge whether the targets are ambitious, whether they will be meaningful. So, to that respect, where we can, we're pushing for harmonization of standards. I know some of the questions are coming through asking about different standards. We're pushing for harmonization of standards as much as we can. We think there's a lot of really good standards out there, and it's really about just bringing them together rather than inventing something new. In terms of, then we're looking at the materiality. We would often use the Salisbury grid work as a starting point as financial investors. We're looking at the financial impact that climate risks can have on operations. And also just understanding where companies have that license to operate. And that's when we would look at really sort of the double reporting standards.
Great, and hopefully we'll get a chance to come on to standardization shortly. Just a question for the audience then, one of the polls that we discussed earlier, if you could maybe get that on the screen. So according to the TCFD's 2020 status report, what did expert users identify as the most useful information on decision making? So half of you have said the impact of climate change on a company's business and strategy, which is exactly the right answer, but all the others are obviously important too, but they identified the most useful as that impact on the company's business and strategy. So thank you very much, all those of you who responded. So we're going to move now with our panel to a little discussion on the risk assessment and risk management approaches. Risk management pillar of the TCFD recommendations asks for companies to disclose how the organisation identifies, assesses and manages climate-related risks. Climate risks can be distinct from wider risks, and they can be novel and uncertain in nature and may have longer time horizons and have different effects based on geography and activity. There's also no one set way to approach climate-related risk, with companies exploring a variety of different approaches. So that could include full integration with wider enterprise risk management, or specific risk management process looking at individual hazards, which is some of what Peng has just described earlier. It is important, however, to ensure that climate-related risks are considered proportionately to wider organisational risks and that material impacts are disclosed. So coming to you, Cassandra, for sort of the GSK approach, just looking at risk management and the concept of materiality, how do you determine what is material for the purposes of your TCFD disclosures?
Yeah, so thank you, Helen. So for the purpose of what is disclosed, TCFD actually advises companies to determine their materiality for climate-related issues that are consistent with how they determine the materiality of other information they include in their financial filings. So our disclosures are aligned with the determined materiality for our financial statements as a whole. So this is definitely an area that finance can really lead on and help the wider team working on TCFD disclosures. And there is definitely, I guess, a lot of discussion and conversations to be had, particularly more around what materiality means to different, because there's quite a few definitions across the board, such as SASB, GRI, and IASB. But really what we're focused on coming back to is tying it in and having that link to the financial filings when we do our disclosures. It's interesting also to see there's a concept of double materiality and referencing your A4S Essential Guide to Enhancing Investor Engagements. It actually talks in there about the tricky issue of materiality. And points out, so it shows the TCFD disclosures and what they are asking, but then also the concept of double materiality, which is something that at GSK we are keeping an eye on.
Great, thank you, Cassandra, and thank you for referencing our Enhancing Investor Engagement Guide. So Supriya, coming over to you in terms of how this works at NatWest. So integrating climate risk management into wider risk management processes is, as suggested, a key part of the TCFD recommendations. But assessing how climate risk can impact upon the organisation is often a developing area. So when you consider climate risks, what do you use as your criteria for assessment, and how comparable is that with your overall risk management process?
So the way we approached embedding climate risk within our risk management is we've got a dual lens. So we already have established risks within our enterprise-wide risk management framework. And as climate risk started to kind of become a material risk, what we tried to do was embed climate risk within all those established risks. The only thing is there's about 13 of those, obviously impacted differently by climate risk to varying degrees. And as we were doing that, we also realized that climate on its own is a substantial risk as well. So we've identified climate as almost its own risk as well. So what we are looking to do is embedding climate. So our biggest risk, say, for example, is credit risk, i.e. people we lend to don't give us the money back. So if you think about it from a customer's angle, if you think about, say, a car manufacturer, right, they have a massive transition risk because a lot of car manufacturers are trying to transition to electric vehicles, right? So we may have lent to them. They may be using the money that came from NatWest to try and move to electric kind of technologies. That may work, that may not work. So climate adds to the credit risk we carry. Similarly, the market risk we have in terms of our exposures to different markets, that also intensifies due to climate, due to various physical risk pressures, etc. So for us, the way we are trying to actually bring climate risk to life is in our assessment of our customers. So when we, and some of you may be familiar with, we obviously, as we lend, we make provisions. So we had impairments or expected credit losses. And there's an assessment that is done at the time of lending where you see what the customer, if they could default, what does their P&L look like, etc., etc. Now we are starting to bring those climate considerations into that customer assessment. As a bank, we have established environment, ethical and social policies, ESG, I've said it in the wrong way, policies, and we use that to assess our customers' kind of exposures, and if they are sort of working in an area that is not considered environmentally sustainable or ethical or not socially sustainable, we have strengthened those policies to include climate criteria. So say, for example, for oil and gas, for mining, we have strengthened those policies because we have an ambition to only support customers in the oil and gas sector that have transition plans to become greener, aligned to Paris. So what we are doing is we are using climate as a framework and applying it to our existing risk management processes. and strengthening the policies we have so we can use that for customer assessment, but then also using it as its own risk so we can monitor it quite closely at a senior level. Because while risk management is one of the key criteria for TCFD, so is governance, right? So you need to demonstrate it's kind of happening at the top, it's happening at the right level, and climate is being monitored. So it's sort of embedded, but then also its own separate risk is how we are approaching it.
Great, and we hear similar comments from the insurance sector in terms of you're saying that you're not lending necessarily to companies that aren't really trying to have an impact, and we hear similar from the insurance sectors that they're not insuring sectors that aren't trying to have an impact to companies that aren't, and I think increasingly that will be the pattern. So thank you very much. Emily, just coming to you again for that investor perspective. So some companies arguably may not have responded yet to your calls for delivering a low carbon economy and reporting on how they're going about that. What are you doing as an investor to help those companies to respond?
Thanks. Yeah, so it's been a quite a journey, I think, over the last few years on this, particularly in some countries. I think we have a very developed stewardship team. It's around 60 people based around the world, who spend their time both talking to companies but also trying to do what they can to try and educate where people reach out to us and request our help on these issues. In terms of what we are doing, it's now our official position that we do ask for TCFD disclosures from all companies. Last year, I think our stewardship team voted at 17,000 company AGMs, and I think within that there were 6,500 where we did actually have at least one vote against management. So we are starting to take that position where we think that this really is a requirement for companies to be doing in order to make sure that we have that information available to be able to take a view on the financial materiality of climate risks.
So just coming back on that, Emily, obviously it's important for companies to hear not just from Larry Fink, and obviously you mentioned the stewardship team there, about how important it is. What are you doing at the fund manager level to make sure that the companies are hearing that very consistent message from all of their interactions with BlackRock?
Obviously, the interactions we have with every single company will differ, but we do consistently. ESG is something that is embedded in our investment process across all teams at BlackRock. It's not just me as a sustainability expert, but it would be all teams at BlackRock. And having those conversations with senior management around how they understand climate risk is really important for all the investors. As I said, we think of climate risk as important when we think about investment risk. We need to be long-term investors. We need to understand what will happen in the long term, therefore. And so it's conversations that all of our investors will be having with company management in those meetings that they have.
Great, thank you very much. We've got a couple more poll questions. We'll get those on the screen. The first one being, what makes climate-related risks distinct? To check you've been listening. What makes climate-related risks distinct? Okay, let's take a look at the responses. And it looks like most of you were listening very carefully. All of the above have been mentioned in today's webinar. So thank you. And the next poll question. What is the recommended approach to managing climate-related risk? Thank you. Let's take a look at those results. And again, they are actually all recommended. Fully integrated enterprise-wide risk management approach, a risk management approach focused on individual hazards and consideration of climate-related risk, which are proportionate in the context of the company's other risks. So correct, all of the above. Just looking at some of the questions from our audience, we mentioned earlier there was one around standardization. Actually struggling to see it right this moment, but we'll go in a different tact. So the question that came in from Robert, which is looking at the TNFD, so the Task Force for Nature-Related Financial Disclosures, which is obviously inspired by the TCFD, saying that we're getting increased interest from investors on biodiversity. So asking the panel what are views on TNFD do we see it going in the same way as TCFD? Cassandra, I think you mentioned nature earlier, or maybe I mentioned nature in the introduction to GSK. I don't know if that's something that you feel able to comment on, the TNFD?
Yeah, happy to. So TNFD, gosh, all these acronyms. So I think they launched back in June sometime, and actually there's a list of various CEOs and CFOs that are supporting that. So Ian Mackay at GSK was one of those that is supporting the, I guess, clear, concise reporting of disclosures on nature. So yeah, I think it's definitely one that we will see more on, and is actually becoming more and more important, to focus on biodiversity as well as not just the climate alone.
And Emily, is that something that you're looking at this point as investors?
So it's something that I don't think is, obviously it's just not as developed at the moment. So for us, what we would take from it is really looking for financial materiality. So in that respect, I think that we're generally seeing lower materiality for the majority of companies, but that's certainly our area of focus within it. And obviously for some sectors more important, but in the main.
Of course, fantastic. And I have found the question now on standardization, so apologies I couldn't see it quickly before. So the question here is about the contributions of TCFD to the upcoming international sustainability reporting standards. So I guess my question to the panel off the back of that is, how much do you see that contributing, and what part is TCFD playing within your own considerations around standardization and bringing your reporting closer together and making it useful for investors? I don't know, Supriya, Peng, whether either of you want to comment specifically on that?
Yeah, happy to answer. So I guess we internally refer to this as an alphabet soup, because there's just so many standards, and they're all different, but they're all aligned. So I think it would actually benefit quite a lot, and from a reader's perspective and also a preparer's perspective, because all of us, so TCFD, if I take it as an example, is now quite established. So whenever we get to standardization request would be that we don't disregard it, but use that to set up a framework that kind of uses TCFDs based on TCFD, but then kind of helps maybe by sector align to the requirements of TCFD and make it more specific, provide more guidance. Similarly, if I look at in the ESG space, there's quite a few standards. There's a lot of frameworks. There's the principles for responsible banking. There's the SASB. There's literally lots of them. So I think we support standardization. There's no particular kind of regulator or body we are looking at, but I think the request is out there in terms of it'll benefit us. And I think if you look across the sectors, even in banking, different banks are following different frameworks, and that makes it very difficult for investors to make decisions because they can't compare like for like. We also internally spend a lot of time answering a question in terms of this bank published that, what does this mean for NatWest? So it'll help the industry as such, and the readers and investors and decision makers if we could standardize. So all for that.
Great, thank you, Supriya. Peng, yep, great. You have something to add?
Yes, hi. So I happen to be on the GRI ASEAN Consortium group. So we have been reporting according to GRI, I think before SASB was known to us. So I'll be very honest to ask, we get a lot of queries, and I saw another question, CDP, SASB, GRI, it is an alphabet soup, and whilst we support standardization, in the interim, investors and external stakeholders still request certain information in a certain way, in a certain format. I think the way we just have to move forward is we call it a blend, okay? We call it a blend. Yes, I understand SASB comes from a financial materiality perspective. So there was another question about duality of materiality. And it's true. If I just use SASB real estate, I don't have to report a lot of things. Suddenly I don't have to, because it's not deemed to be financially material. But we have been, and we know that there are certain stakeholders who are very interested in our social license to operate, for instance. So then we adopt a dual materiality. The challenge is then the list just gets longer, and internally the issuers or the reporters just need to make sense for the internal and external stakeholders. So I'll be very honest, when BlackRock asked us to do SASB, we just, but we understood they want comparable data. So we put it out there in the comparable data perspective. I have a GRI disclosure, I have a SASB disclosure, but our narrative is the same, because we're going to address the risk and the opportunities in the same way. But when it, and this will be a challenge for any listed company, because I can tell you, we participate in the CDP and they ask for data in the way. We are a real estate company, so there is a benchmark for real estate companies. It's called Global Real Estate Sustainability Benchmark, GRESB. So they tend to align to SASB. But we have participate in indexes that tend to align to GRI. So we internally make sense of it, we blend it, and internally when we set our targets for our remuneration, for our scorecard that will impact the bonus, we have to digest it and make it into a lens that our internal stakeholders have to understand, so that we move in the general direction. So my final comment is, instead of overly looking at which framework standards, I think that's the reality. We'll have to struggle with this soup until, I don't think it will ever get blended, but I think to really push for comprehensive reporting. I hear what Supriya said. Some companies report HQ data only, some companies report top 10 markets, top 3 markets, but that's not your footprint. That is not your full financial disclosure. You report financial profits for everything you do, right? So we should strive for the most material as much as possible. And that's where we want to come from: full disclosure on your portfolio, external assurance on the entire portfolio. Then that's, to us, a more true disclosure. But we hear different stakeholders. In the meantime, I do apologize, our report has TCFD disclosure, SASB disclosure, because we haven't figured out a way to blend all the numbers and not make that into a 300-page document that people will just, bang their head. Yeah, I hope that answers the questions that were posed.
Yeah, so what I'm hearing is be transparent, be as comprehensive as you can. And it doesn't sound like you're confident that standardization will be with us in the near term, but hopefully it won't be too much longer. You commented again on dual materiality, and I was coming to that question next, actually, and it's come up a couple of times on the panel in terms of having materiality from a financial perspective, and also another from an impact on society and the environment. I guess it would just be here, any other thoughts from the panel on dual materiality? What do you? I think, Cassandra, you touched on that, and Supriya, I don't know, do you have a dual materiality? Do you use that approach, and what does it mean to you?
Yeah, as I mentioned before, I guess we see dual materiality as how climate impacts the bank and how bank impacts climate, right? So in terms of how the bank impacts climate, we have set our kind of ambition to reduce the emissions from our financing activity, which is our loan book, by 50%. So basically, when we lend to customers and they use the money to do whatever activities they do, we are now working with customers to support them in terms of helping them transition, right? So that will help, that will be NatWest impacting the environment in terms of reducing the impact. How we get impacted by the environment is, as I mentioned before, right, because of the transition and physical risks our customers carry, it is enhancing our risk, whether it's credit risk or other things, and we are setting up processes to assess those and make them better. So we are considering of it as how we can impact and kind of the climate kind of journey of the world and how that is impacting us as well. So we are very mindful in our decision making that we look at both those lenses.
Great, thank you very much. And I guess final question, perhaps to each of you, your perspective is the question here around TCFD and setting out down the TCF route for the first time. Is it a significant undertaking? How do you know where to start? What do you prioritize? What's worked well for you? So I guess my question is, what's your top tip for somebody starting out? And Cassandra, why don't we come to you first?
Yeah, so thank you. So we actually talked about this in our case study, so you can see a bit more about it. But I think it's probably really much collaboration. I think for me is really working with sustainability, finance, external reporting, and collaborating together. I think the sooner that you sort of do that as you're setting out, I think the easier the journey will be.
Great, thank you. Peng?
Hi, I think from our perspective is just to share is when we were first posed the TCFD, we were very daunted. And I remember the stock exchange told us, hey, you actually have elements of TCFD already. In fact, all the companies would have, because every company has to look at risk, right? Every board has to look at risk, you know. We're just asking you to focus it. So I would encourage for first-time adopters not to be daunted. There will definitely be something in your organization that will fit under governance, under strategy. Surely you will have matrix because you pay energy bills, right? So there, start somewhere. And I think disclosure only works if you have something to disclose. So I strongly urge people to start working on the pieces while you prepare for the disclosure. Yeah, that's my tip. Thank you.
Great, thank you. And Supriya, what about any banks listening? What would you give them a tip to get them started?
Yeah, I think the biggest issue for banks is probably data quality. And I say this all the time, is it's acknowledged across the industry that data isn't perfect. So don't wait for perfection, just make a start, disclose the imperfections, and be really clear about where we're all struggling. And we'll figure out that we as an industry need something to change, you know, to make disclosures better, but make a start. And be transparent about data quality issues rather than waiting for it to become perfect.
Great. And lastly, Emily, anyone in your shoes, any investors out there?
Well, I would say from our point of view, we're grateful for anything. So our encouragement would be just to start, because it's really hard for us to judge when there's nothing. But as soon as there's something, we can have a conversation about, you know, how the report could improve, where it could go, what else we'd like to see. And we're always really happy to give that feedback, you know, where that's helpful, but we just need something to be able to start with, to be able to start to do that comparison. And we recognize it's quite a journey. And so that's, I guess, particularly why we'd encourage people to really start now.
Indeed. And of course, the better quality data that you get in, the better quality that you're able to report yourself in turn. Fantastic. So thank you very much to all of our speakers. It was great to hear all your different perspectives today. And thank you very much to all our listeners for all the great questions that you've submitted. If I can hand back to my colleagues now to see us through to the end of the webinar. Thank you.
Thank you, Helen. So I'm just going to take you through some of the documents that we have on our A4S website and some of the resources that might help you to implement TCFD, both when you're starting out and developing. So first we have our top tips document for finance teams. So these top tips have been tried and tested by finance teams as they work towards implementing the recommendations. And they're mostly focused on finance teams getting started. So they're a really good kind of document to start out with. The maturity map that was mentioned through the discussion is a kind of an assessment of to look at where you are on your TCFD journey and can help you to identify where you need to improve. There's also an insight series, which has a range of practical examples, and they consider the application of the recommendations with top tips from leading companies. The reporting examples demonstrate good practice disclosures from organizations' annual reports. And we also have a very recently released FAQs document. So in recognition that performing scenario analysis can be one of the most challenging and demanding tasks because of the complexities that it carries, we've developed this guidance for finance teams, and it answers frequently asked questions to help finance teams enhance their knowledge of scenario analysis and guide them through the process. So this is based on our A4S work with companies across multiple sectors and the insights that we've gained from supporting TCFD since its inception. The questions that we address include what factors should be considering when selecting scenarios, how are scenario analysis findings integrated within business strategy and decision-making, how should businesses report their scenario analysis findings to respond to investors and other stakeholders' needs. So all of these materials that I've mentioned and other useful resources will include in an email to you that will circulate after this webinar. And before we wrap up, I just want to thank our speakers again for the really interesting discussion today. Following the session, we'll send out a link to the webinar recording, an invitation to the next webinar on finance culture, which will take place on the 26th of October, and other useful TCFD resources, including the TCFD FAQs. So I just want to run a couple of last polls. So we'll first run our call to action. So how will you translate what you've learned at the workshop into your work for the next 6 months? And if you could tick all that apply. So read the TCFD recommendations report, the A4S top tips, scenario analysis, FAQs and case studies. Use the A4S maturity map. Identify ways that you can get started or involved with implementing TCFD. Talk to your CFO and finance team, and engage with internal stakeholders to understand climate risks and opportunities. The results are just coming in. And there's a really nice spread, so a lot of people can read the TCFD, so the documents that will circulate after the call. A lot of people use the maturity map to assess their kind of status and identify ways that they can get started in implementing TCFD. So that's really good to see. And lastly, it's really helpful for us to get your feedback to make these sessions as useful as possible. So just before we sign off, if you could complete a feedback poll, I'll leave the poll running. And I just want to say thank you to our speakers and thank you to Helen again, and for all of you who've dialed in. And we hope to see you again soon and at the next session on 26th of October. So just for the final poll, the webinar was helpful and I got some useful information. Strongly agree, agree, neither agree nor disagree, disagree or strongly disagree. Thank you very much for your time today, and I hope you have a great day.